Hello everyone, and welcome back to the channel. Today, we're talking about gold, but not in a hype-driven or price prediction way. Instead, we'll look at gold through the lens of the U.S. economy, specifically U.S. debt, economic data, and inflation. This is my personal perspective. This content is not financial or investment advice. U.S. government debt has been rising for many years, and more importantly, there are no real signs of it coming down. Whenever government spending exceeds revenue, debt continues to grow. To sustain this system, the government must borrow more. As borrowing increases, pressure on monetary policy also increases. Over the long term, high debt makes it difficult to keep interest rates elevated. Because higher rates mean higher debt servicing costs, and rising interest expenses quickly become a burden on the federal budget. This is where gold begins to play its role. Gold is not issued by any government. Gold carries no default risk. Gold exists outside the monetary system as a neutral asset. As debt rises and currencies are gradually diluted over time, gold is often viewed as a tool for preserving purchasing power. Not to get rich quickly, but to protect value over the long term. Many people believe gold only reacts to physical supply and demand. In reality, gold reacts most strongly to U.S. economic data, because economic data drives Federal Reserve policy, and Fed policy drives interest rates and the U.S. dollar. The most important data points include inflation, such as CPI and PCE reports, employment data like non-farm payrolls, and the unemployment rate. When economic data comes in weaker than expected, markets begin to believe the Fed cannot stay overly restrictive. Expectations for future rate cuts start to build. The U.S. dollar weakens, and gold typically benefits. On the other hand, when data comes in stronger than expected, the Fed has more justification to keep rates higher for longer. Bond yields rise, the dollar strengthens, and gold faces short-term pressure. The key point is that gold reacts to future expectations, not to what has already happened. When inflation is high, money loses value more quickly over time. The cost of living rises, purchasing power declines, confidence in fiat currency weakens. In that environment, investors look for safe havens. Gold is commonly viewed as an inflation hedge, not because gold generates income, but because it tends to preserve value better than cash. As a result, during periods of high inflation, demand for gold often increases, and gold prices tend to rise. Many people assume falling inflation is negative for gold, but that's not always true. The key question is why inflation is falling. If inflation declines because the economy is slowing, because consumer spending weakens, because recession risks increase, then the Fed may be forced to ease policy. Interest rates may fall in the future, and in that case, gold can benefit again. So gold doesn't only rise during high inflation. Gold also performs well when monetary policy turns more accommodative. Gold is not designed for short-term trading. Gold is not for those seeking quick profits. Gold fits a long-term mindset. Gold fits investors focused on wealth preservation. In a world of rising debt and continuous currency dilution, gold acts as a form of financial insurance. Not perfect, but essential in a balanced portfolio. If you found this video helpful, please hit the like button to support the channel. Subscribe for more macro and gold market analysis. We'll continue discussing gold, inflation, and long-term wealth protection. Thank you for watching until the end. I'll see you in the next video.